Okay. Good afternoon, ladies and gentlemen. Thank you for joining us today in our LIBOR transition webinar. I'm pleased to be joined by David Olone, AUB's Deputy Group CEO, Treasury and Investment, and Martyn Hoccom from First Abu Dhabi Bank. He's the Group Treasurer there. Thank you for joining us today, and we look forward for an insightful discussion. Now, LIBOR, also referred to as the world's most important number, is a globally recognized base rate for pricing financial contracts worth trillions of dollars, including bonds, loans, derivatives. The transition from IBORs to alternate reference rates, ARRs, by end of 2021 represents one of the most significant changes in the financial industry, given its scale, magnitude, and the challenges involved, including transition risks, the impact on the financial pricing, as well as all the legal and operational aspects that also need to be managed. So let us start with a brief overview for the benefit of all, and perhaps David, you can take up this question. What is meant by IBOR, and why have the market regulators decided to seize it?
Good afternoon, Zeeba. Thank you for, first of all, inviting me to this BIBF seminar. So LIBOR, as some of your viewers will probably be aware, is the London interbank offered rate, and it first emerged in the late 1980s in London, although its genesis actually was much earlier. It was in the kind of very late 60s, early 70s. And it's meant to represent the rate at which certain London-based banks lend to each other in a range of currencies. And currently that's dollars, sterling, euros, Swiss francs, and yen, and across a range of tenors, which go from overnight out to 12 months. It's calculated on the basis of the submission of these banks, these panel banks as they're referred to. It's an arithmetic mean, and so therefore it changes on a daily basis. And probably most importantly, which you already alluded to, it's widely used as a benchmark for short-term interest rates or for floating rates for many cash products such as loans or bonds or mortgages and deposits, but also many derivative products as well, including swaps, futures, options, and so on. And it can also serve as a gauge of the market's expectations of the trajectory of interest rates, whether they're going to go up, down, or stay the same in the future. And it can also give some indication of the level of stress or not in terms of funding markets more generally. Now, why did the regulators decide, or the regulatory community decide, that these rates were no longer reliable and representative? And I think really there was two broad reasons behind this. I think the first was to do with the decrease, and in some cases the complete absence, of underlying reference transactions, because post 2008, when the financial crisis hit, interbank money markets dried up, banks stopped lending to each other, and therefore there wasn't any transactions to actually reference the underlying rate. I think also, which we'll be aware of, there was a number of instances where banks or traders or brokers were either accused or in some cases found guilty of manipulating LIBOR for their own benefit. And that obviously undermined the bona fides nature of the rate. So I think for those two reasons, the regulators, primarily driven, I think, by the UK and the Fed, by the PRA, I should say, and by the Fed, began to think about how we would transition and move away from that. And I suppose the last point that I would make is that when we talk about LIBOR, and I know you said this correctly at the start, we actually should shorten it and talk about IBOR. It's not just London interbank offered rates. Interbank offered rates more generally around the world, so for example Euribor would be another example, are also in the same frame in terms of remediation.
Thank you, David. Martyn, I would like to hear your views as well on this, and maybe you can also give us a guideline in terms of when this transition, the timeline of the transition, and what key dates are we looking at as well?
Yeah, thank you, and thanks for the invitation to the conference. I think David summed up well the nature of LIBOR and the reasons that it's being phased out by the regulators worldwide. It's something that is now very, very pressing, in fact, because some currencies like sterling, as early as the end of March, you won't be able to do new transactions referencing LIBOR loans. And for the US dollar, that's out until the end of 2021. And the intention in the US is that there won't be new loans after 2021, and they'll be looking by 2023 to phase out existing arrangements. So this is something that is very much here and now. And what I would say is that the preparation behind it is quite extensive. As you said in the introduction, Zeeba, I think the analogy I hold is it's like you have a house that's 40, 50 years old, and somebody says there's a fault with the electrical system, and someone has to come in and replace all of the electrical wiring in the house. Now, it's not something you can do in isolation. You have to go into every room, you have to rip the whole place apart, and you have to replumb it. And it means you have to go into the compliance room, and there'll be lots of things to do for compliance. There are lots of things to do on systems and operations. Think about within your banks how many of your systems, well, one, how many systems there are, and in case of FAB, that's probably 20 or 30 major systems. They're referencing LIBOR. All of that infrastructure needs to change to these new reference rates. The legal arrangements that you have with your clients, the fallback language. If you cease having a LIBOR product and you go to a new reference rate, what does the legal documentation say? Then the people that run conduct risk will be saying, well, what does it mean for conduct? And as David said earlier, one of the main drivers that we're moving is because of perceived conduct issues. So we're going to have to really, really show that customers are not disadvantaged by this move, that it's done in a very transparent and open manner. So I really say that one, the debate on whether LIBOR is going is over. It is going, and it's happening, a lot of it here in 2021. So that's really the state of play.
Okay, thank you for this insight. And continuing on what you have just mentioned, so I'll tackle the financial aspect of it. Now, obviously, LIBOR has been referenced into contracts worth trillions of dollars. So now, in terms of the replacement of these IBORs, can you share your insights about this? I mean, what is going to be replaced in those contracts, and how going forward will those products be actually priced? So maybe Martyn, you can share your views on this.
Yeah, sure. And again, well, I think hopefully people on the audience, there's lots of sites to go to understand the new reference rates. And it's different by each currency. So in the case of sterling, they're using a thing called SONIA, the sterling overnight rate. Now that's an unsecured rate. In the US, they're going to a reference rate called SOFR, the sterling overnight finance, the overnight financing rate, sorry, the secured rate. So it's a secured overnight financing rate. So you've already got a difference there between the markets, that some markets are going with unsecured LIBOR, some are going with secured reference rates. Some, like in Europe, are still developing their framework for ESTA, and so it differs jurisdiction by jurisdiction. And I just to emphasize again that what this really means is that you need to have a plan for each of those individual currencies, because it will be different and it will impact your systems differently, the regulators that you're dealing with differently, and the standards that you need to adhere to. So if I probably develop the conversation slightly, and so given so much is happening, how do you organize this, and when do you organize it? So just to give people an idea of the journey that we've been on, we first set up a program to deal with this in 2019. Now that was interesting. That came out, I saw a couple of FT headlines, and one was from the chief executive of Barclays at the time, who said that the move to new LIBOR rates was a bigger deal for Barclays than Brexit. And I thought, well, Barclays being a UK bank, Brexit's a big enough deal, so this must be really something to get to grips with. So the process that we went through is we went out to a number of banks, actually, banks that we deal with, like Citibank and ABN AMRO, a couple of others, and asked them what they were doing, and they'd set up big projects. We in FAB had just gone through an integration project with the merger of FGB and MBAD. So basically we decided to use all of that infrastructure to manage this project. It was an interesting conversation at the time, because one school of thought said, well, look, this is LIBOR, this is to do with Treasury and markets. Let Treasury and markets sort it out. And we quickly came to the realization that was far too narrow a view to take, because this would be impacting customers, the contracts they have with customers, the fairness in pricing with customers, conduct risk, fundamentally all of the systems in the bank. So we have lots of loans, and we've been publishing this actually in our annual report, but about 50% of the lending done by FAB is referenced to dollars and sterling and currencies that are impacted by the transition. So it's a big issue across the bank, and it hits all of the systems. And also we reference, it's amazing, like David said, it's got so much into the DNA of the whole system. So much is referenced to LIBOR, futures markets, and then what do you do with pricing futures? What do you do with your value at risk models in the risk space? So we concluded that we needed to have a group projects team that had project experience to guide us, and that Treasury and markets would be one of the big pillars, but we'd also have a legal pillar, operations, lending, and so on and so on. And we've also, in setting that up, we've used external support as well, with consultants to share, because places like the US and the UK, well, the banks there are kind of spent more time on this and developed. So we also set another principle, which was we would try and follow the market. We're a bank here in the Middle East. We're not going to be setting the standards for the UK or the US or anywhere else. The standards will be set, but we need to be fully aware of where they're heading and make sure that we're anticipating it and making sure that our operations and systems are ready for it.
Yeah, that is indeed true, because the whole financial industry has been used for decades on LIBOR, and now suddenly it is changing, and having that knowledge, that awareness, and all the different teams within the bank that is going to be affected is a big thing. So the role of leadership is extremely important in that sense, and the pre-planning and obviously external help would be, I would guess, invaluable in that sense. And David, maybe you can share your thoughts about this and how AUB managed to tackle the transition.
Yeah, very, very similar to what Martyn was saying, which was that we started in 2019 also. And it probably took us the guts of a year to actually be able to intimately understand what we needed to do across the bank. And the reason for that is precisely what Martyn just said, was that it started off with people saying, look, this is a treasury issue or this is a risk issue. But in fact it isn't, right? It's every legal entity of, we again, similar to FAB, we have a number of subsidiaries and a number of affiliates. So it was affecting every single subsidiary or affiliate in a greater or lesser extent, depending on the business. It was affecting every line of business to a greater or lesser extent. So certainly our corporate banking business, our treasury business had material implications for us. Private banking had some implications, and retail were somewhat less so. And then when you look down to the support functions, be they risk or finance, so from a risk perspective, how do you do your models, how do you do your VARs, how do you calibrate the risks, the change in risks that occur? And from a finance perspective, there's some quite interesting things, which is that at the moment, whether you take a SOFR or a SONIA or an ESTR, is the principle of backwardation. So the floating rate leg or the floating rate itself is calculated at the end of the particular period, as opposed to being known at the beginning. So how do you do a daily accrual from an accounting perspective? And I'm just highlighting a few of those points, and Martyn alluded to conduct as well. Really, just to kind of corroborate what Martyn is saying, is that it went through everywhere from a business perspective, and therefore it had to be a group-wide project. Now, the relatively good news, though, which we have found, is that once we got our planning and understood the implications of what the project was going to entail, actually the execution became a little bit easier. And partly because, you know, if you plan, and if you plan appropriately, execution does become easier, and partly because, as Martyn was saying, we're following the market. We're not having to lead the market in terms of coming up with solutions. We're actually following the solutions, the direction of the market, and putting in place our own solutions for it. But it's a big project. Brexit's a good analogy. If for those who are maybe old enough, Y2K is another good analogy.
Yeah.
From a lot more perspective is kind of how we did it. But the point is exactly the same. It's a material piece of work.
Exactly, it's very true. It kind of reminds me of the Y2K, because it was like, you know, when the system is going to change to the 2000s, what's going to happen?
Yeah.
And yeah, so I'm wondering in terms of how it is going to affect us. I mean, in terms of the rates we are more familiar with here, like the BIBOR, CIBOR, the rates in the GCC. What's going to happen to these rates? How are they going to be affected?
I mean, I'll certainly take that one initially, if you like. I think the rates within the GCC have some similarities and they have some differences. So what are the similarities? If I just take CIBOR and BIBOR as the ones that I'll be more familiar with, they're an averaging process of money market rates, so quite similar conceptually to a LIBOR or an IBOR type rate. What's the difference? The difference is there's no derivative market associated, or no material derivative market associated with either of those two rates, which has implications, obviously, particularly in the course of conduct. And equally, they're not as systemically important within the domestic economies as, for example, say, sterling LIBOR would be in the UK or dollar LIBOR would be within the US. That said, they're still important, right? Because we have people who would borrow, if I take BIBOR as an example, people who have BIBOR-related loans or CIBOR-related loans or deposits. So I know that the CBB here, and indeed probably all of the regulators within the GCC, are very focused on the local IBOR rates, and I suspect in due course we will hear their thoughts as to how that should progress as well.
Thank you, David. I'll be taking a couple of questions. There is a question about the role of the regulator, and you just touched based on it. But the question is that some regulators are planning to defer the implementation based on concerns of international banks. And any thoughts on this?
Well, of course, it depends what they mean by that. Clearly, the regulator, just going back to building on what David was saying about the local rates, CIBOR, EBOR, and so on. So the central bank here has taken the stance that they've actually set up a working group with the principal banks here to track and monitor what happens with the LIBOR reference rate transition for sterling and dollars. And I think they'll wait and see how that turns out, so to speak. And in the meantime, you know, maintain their current system, because it would be too much upheaval to try and change it right now. But in terms of the question about what the regulators can do, clearly what's happening to sterling and dollars is with the Bank of England and the Federal Reserve and the ECB and so on and so on. So to that extent, you know, if the Bank of England say that you can't do LIBOR loans after the 31st of March, well, that's it. That's the rule for sterling, and ditto for dollars, you know, for 2022. So obviously the regulators here, you know, I think the sensible stance would be to see and support the banks in the region go through the transition with sterling and dollars and other currencies they may be involved with. And then from the lessons learned from that, maybe in 2022, look at if there is a way to, move to alternative reference rates in the region.
Okay. Thank you, Martyn. David, if you want to add to that.
Yeah, I think I would add to that. I think that the time, first of all, the intent of the regulators, whether it is the Bank of England, the Fed, or the ECB, is very clear and it's unequivocal, and that won't change. I think that people need to be ready at the end of. There's various staging points depending on the rate and depending on the currency, but as Martyn's alluded to, there's various staging points along the way, and people need to be ready because it's not for turning back.
Okay. Now, another aspect is in terms of the customers. So the customers who are depositing money in the banks, or for example, they have mortgage loans, should they at all be concerned about this transition? Could this adversely impact, for example, their savings, borrowings, and should banks start, or is it something that is on a wider level, be an awareness campaign taking place? If you can share maybe your thoughts on this. Yeah, David, I'll start with you.
Sure. I think the very first thing is that I don't think customers need to be concerned in the context of whether they have deposits or whether they have loans with any institution that's referencing LIBOR. What I mean by that is that if the bank has not already been in contact with the customers, they will be in contact with them in due course, right? And full clarity of all of the information that the clients will need along the way will be given. And I think the key point that people should remember, and again it's something that Martyn alluded to earlier on, is there's the whole philosophical approach of making sure that customers are treated fairly and making sure that banks carry out this transition in a way that is appropriate from a conduct perspective, and actually making sure therefore that customers are not left any worse off as a result of this. So I think that all customers, whether they are impacted at a retail or a private banking or a corporate or otherwise level, can be quite relaxed about that. And that communication will happen. In some cases, it's already happening. It just depends on the nature of the clients. But I think they can be quite relaxed about that.
Okay, and I have another question, which is asking about, we have some update or discussion regarding recent consultation by IBA regarding postponing the LIBOR ceasing deadline to 2023. Any thoughts about this?
So this was on, is this on the US market they're referring to?
Yeah,
so there has been some,
IBA, yeah.
what the US have they slightly changed their timeline to say that you can write loans in dollars until the end of 2021, but after 2021, no more new loans. But they won't just stop it on the 1st of January, but they'll then allow through 22 and 23 people to get ready for the transitioning the current stock of loans onto the new reference rate. So I think there's a slightly longer timeline on the US, but a very short timeline on sterling at the moment.
Yeah.
Okay, thank you, Martyn, on this. And I have another question, which is about, how did the non-financial institutions react to this? So for example, in terms of corporate clients, now, as you mentioned, there are a number of legal documentation that has been agreed with the corporate clients, and obviously they do have commitments with their own projects. And so how would the change in pricing affect this? Does it have?
There's a lot of work to do there, I think. With it, I think David alluded to it already. But again, I think to the question about what about our customers? Well, we've set up a customer outreach program. We've started putting things on the website as general guidance, just so customers are aware that this is happening. And I think just get the perspective here of the things that our customers in this region are focusing on in the hospitality and the airline sector and so on and so on. The COVID crisis is just taking all of the oxygen from everything. So to expect the corporate sector to be fully online with, you know, what to them is probably an arcane thing, a reference rate is changing on their contract. They'll be looking to the banks to take care of this for them. So I think it's our responsibility. We, the banks, need to inform our customers. We need to explain to them what the changes are. As David said, there's a lot of protocols coming out from people like the Bank of England and the Federal Reserve about when you transition from a LIBOR rate to alternative reference rate, how you do that in such a fashion that the customer is left in the same position as he was before. So it's a completely fair and value neutral transition. But, you know, in the same way that we're having to kind of change our systems and change our processes, you know, some of our customers as well have systems that they're calculating their interest on, that they're doing accounting for, and there's some quite changes, you know. So, you know, again, as David said, that one of the things that people liked about LIBOR was, especially from we've had feedback from customers, was at least with LIBOR, if we said, well, we're setting the rate today for 3 months, we knew for the next 3 months what our interest cost was, and they could put it into all of their systems and have the cash ready to pay the interest. With these reference rates, because they're backward looking, you don't have that same process and certainty. So there's quite a lot to do there in a practical sense. And certainly the way we've tackled it is to say that we need to reach out to our clients, we need to explain what's happening, explain that we're going to make sure they're neutral, and also just kind of say there are accounting and processing requirements that you may need help with. You should certainly identify if we can help you, or maybe you've got other ways of fixing that. But I think really, really important, because the thing that will be remembered after this LIBOR transition is our customers, because, you know, that's the main thing. If we have issues with our systems and hedge accounting and some of our risk numbers aren't quite right, you know, they're all issues. But if we have, you know, as an industry, customers that feel they haven't been informed and haven't understood it or are complaining about it, that would be so, you know, given the experience of the banks back 10 years ago, especially in the West in 2008, we're doing a lot to rebuild faith and trust with our customers. And to me, getting this right getting the customers right is the most important part of that pyramid of all the things that we need to do.
A very, very interesting point of view, because I do have a question about how banks are going to be transparent about the pricing, especially, you know, given the discrepancy or the difference between the LIBOR and the SONIA software ratings. So the transparency, as you rightly mentioned, is extremely important. And David, I will come back to you. So in terms of your knowledge about the stage of negotiations with the clients, with the bank customers, how far or did banks actually start doing this, whether it is from AUB or if you have any knowledge about how regionally this is actually picking up, since it's going to be implemented by the end of the year?
Yeah, sure. I think from an AUB perspective, we would be very similar to a lot of banks in terms of beginning to having published communications either on a web or directly to customers in a written form, with follow-up conversations from relationship managers typically. So I think that communication process has definitely started. I think there is a couple of points though that are worth making, which is that in some cases, what you're going to transition to and the exact methodology of how you're going to transition, that hasn't been specifically decided yet. And if I used 2 examples just to highlight a point, if you look at, let's say, the UK, it's very clear that people are going to go to SONIA in terms of corporate loans. It's very clear that they're going to do a credit adjustment spread in order to try and mitigate any differences between that rate as an overnight unsecured rate and the LIBOR rate that it would be replacing. But in other markets, that's not quite as well developed. Now, I think that will be developed, and, you know, in terms of when we actually get to sit down to just have specific conversations with certain customers to say, here's how we're moving, here's why we're moving, here's how we've come up with this, here's how we reference this to the overall backdrop of what's happening in the marketplace. So it's a thematic thing for the whole of 2021, probably a Q2, Q3 to be realistic, with from a communications perspective. But again, to re-emphasize the point, there is a no value transfer approach to this, i.e. customers will not be worse off as a result of this transition, and that's absolutely key. And it's not just a conduct issue per se, but it's a business issue, right? No business is sustainable in the long term, right, unless you have good relationships with customers. And you can't have good relationships with customers, right, unless you actually treat those customers fairly, whether that's a financial institution or any other industry. So I think that's the point that really people should be quite comfortable about if you're sitting on the other side of this. The issues for banks are far greater because, using Martyn's analogy of the wiring in the house, right? But for the customer, they don't live in the house, right? So they're not really that bothered. They just want to know, what's that rate going to be at the end of the day.
Yeah, and I'll refer this question to Martyn. Now, about the ARR, the comment here is about really the liquidity risk and the credit premium, and how would these be factored in while renegotiating pricing with clients? Any thoughts about this?
Yeah, I think it comes back to what David was saying, that, and again, it's the question I always kind of put to my team on the conference calls when we're having these internal, is what standards, in terms of the loans and the credit adjustment that David was talking about, that would go onto the loans to keep them neutral and fair. The question I'm going to ask is, well, what are NatWest and Barclays and Standard Chartered and other banks in the UK doing? Because we're going to, as I say earlier, we want to kind of follow in this. And to the extent there's kind of a formula that says, well, the way that we'll do this is that we'll take this rate, we'll compare it to what LIBOR was for the last X years, and people are working on this, through ISDA, through the London Money Markets Association, and so on. And as much as we can, we will kind of just say, look, this is what we're doing. We're following the best practice that's been signed off by the Bank of England and the PRA in the London loan market. And a lot of loans that we do, by the way, we're in syndicated facilities, so we'll be with other banks and we'll be doing this together. So we'll see all these standards coming. So I don't want to kind of frighten people too much in a sense by the size of this, because these standards will emerge. And I think, as David said, to create the trust and the fairness with the client, we want the long-term relationship. We'll just say, look, this is the alternative reference rate. This was the legacy. This is the formula that people are using and that's been approved by the regulators. And this is what we propose to do. And, we'll be as open and transparent as we can be. And of course, the corporate clients themselves, the treasurers there are very, very smart people in my experience, and they'll be looking at what's happening in different markets and making sure that, they're UK-based banks and what we're doing for sterling are the same, and what Citibank and JP Morgan are doing for $1, that we treat them in the same kind of way and with the same openness.
Thank you, Martyn. David, maybe if you can add on this in terms of how AUB is handling this as well.
Sure, yeah. I think the important thing, and I don't want to get too kind of technical on people here, but the important thing is maybe just to reference what work has already been done, because a lot of these issues have been grappled with over the last couple of years by various working groups. So if you look at, for example, ISDA, which is the body that underpins essentially the legal documentation for derivative markets, for interest rate swap markets, they've developed a protocol which has what's the fallback language in terms of there being a cessation of LIBOR. Now, what does that really mean in simple terms? It says, what's the alternative reference rate and how are you going to calculate it? Okay, that exists, right? And the vast majority of the world's banks have signed up to the ISDA protocol. So within the derivatives market, it's largely known and accepted how those calculations from a LIBOR-based rate to an alternative reference rate are going to occur. Similarly, in repo markets and stock lending markets, and I know, and I'm conscious that these are treasury and wholesale markets, they've signed up to similar protocols. we've had clearing houses, so London Clearing House almost certainly is also going to sign up as well. So the point of that is that you have this kind of huge sway of derivative markets who figured out how they're going to transition from a LIBOR-based rate to, sorry, an IBOR-based rate, excuse me, to an alternative reference rate. Logic then would dictate that where you move to from, let's say, in Martyn's case, mentioning the syndicated loans, is the Loan Market Association will follow somewhat of a similar thinking process. I'd be quite surprised if it was materially different, although I'll come back to one point that I think is worth making in that context. So by the time you actually get discussing with customers, right, in terms of what they're actually moving, you're kind of standing on the shoulders of years and years of work, right, by regulators, by large organizations, by support functions, etc., as to how you got there. And it becomes a little bit easier and almost unequivocal as to which way you go. There is one point, though, that I think is worth making, which is that all of the rates at the moment, whether they're SOFR, whether they're SONIA, whether they're ESTR, leaving aside, I think one question might have alluded to the factor of credit risk and liquidity premium. There's probably a more important point, which is that they're backward. And so at the moment, the way that these rates are going to be calculated is that they're going to be calculated at the end of the floating rate period. Okay. Now, the derivatives market, etc., are all comfortable with that. But if you're, as was already alluded to, a corporate treasurer, you kind of want to know that floating rate in advance, right? So I think there's a little bit of, I wouldn't call it necessarily tension, because it's about how you solve problems that have to be thought through at the moment, which is that the backwardation works for a lot of markets, but not all, right? So syndicated loan markets, for example, or cash loan markets probably would prefer a forward-looking rate. The backwardation works for regulators because it's very transparent, it's very objective, it has transactions underpinning it, so it becomes unequivocal or indisputable as to how that rate was calculated. But at the moment, there's also work being done on how do you build a term structure. So the Alternative Reference Rate Committee in the US are due by the first half of this year to come out with what their methodology is in order to show what the term structure, which is based off derivatives, it's based off basis swaps for so far. And similarly in the UK, the working groups are doing a similar type of project. So whether you ultimately end up with the total market being based on a backwardation perspective, or the majority of the market having backwardation, but also therefore there's a degree of forward-looking rates through some other mechanism, I think that's yet to work itself out. But again, this will work itself out sooner rather than later.
Yeah, just to add to that, David made that important point about the ISDA protocol. So just to kind of share with the audience that, for example, FAB, we've signed into the ISDA protocol for exactly those reasons. We hope the London Money Market Association signs into it. Then we can really just say to the court, because corporates also have derivatives, and say we'll treat your loans and derivatives and the transition exactly the same way. And we're not making the rules here in FAB. We're just following what the international associations have said and what virtually all of the banks in the US and Europe have signed up to already. So again, for those who are treasurers or CEOs on the call, then you know, it's open to you to sign up to the ISDA protocol now and start, you know, firming up these things, so there's less and less uncertainty and more things that are known in your kind of universe. And then, you know, your systems transitions and all that kind of thing, you know what to tell the systems guys to put into the systems in terms of what the alternative reference rates will be.
Yeah, thank you for this input. Now I have another question about the long-term rates, and if there is any update on that and how they are going to be also working in the context of having multiple parties in certain transactions. So any idea, any thoughts about this, about the long-term rates?
But by long-term rates, do you, I'm not 100% sure which specific rates, but if it's referring to, for example, if you have a syndicated loan facility, then I think we will end up following a methodology that's very similar to what's been adopted in ISDA and GIMRA and those types of markets. Now, I can't say that definitively, I'm not involved in those working groups, but I think that's the direction of travel. And all of the banks have to agree, and the borrower has to agree, and so on and so forth. I don't know if the rate, if the question was just referencing long-term rates in general. So, for example, 10-year treasuries or 30.
As a forward-looking kind of perspective.
Yeah. So look, there is a term structure that exists referencing these overnight rates, and from that you can extrapolate forward rates referencing whether it's SOFR or SONIA or so on and so forth. So I think the maths will be slightly different, but the principle is exactly the same. So that can all be still done so long as you have that term structure in existence.
Okay, I have an interesting question, which is asking about whether the new benchmark rate would be less susceptible to any manipulative forces, given that this whole transition started because of that. So what is your view on this?
Well, that is, you know, one of the driving purposes of the reform. And okay, let's build out on that, which is like David was saying, one of the reasons it's very difficult is now is because the interbank market has just become so much less significant in markets like the UK and the US. So there aren't transactions to support, you know, having a 1 month, a 3 month, a 6 month, a 12-month rate, and so on and so on. And I'll just kind of do a slight diversion here, but this is the issue as well, actually, for the GCC, that if the Bank of England doesn't think there's enough flow in the sterling markets to support the current LIBOR setting process, then the amount of flow that's going through Kuwait and the UAE and Jordan and et cetera, you know, it kind of opens up this whole question then about, once this transition is done, what the regulators here do with, you know, a very thin market in LIBOR. So I think that's kind of one, you know, one key piece from that. But the new reference rates that are coming, like, you know, be sterling overnight, because actually there is a big sterling overnight market. There's enough actual real data going through to kind of keep it true, and the same will be of the SOFR market, and I'm sure the Europeans are doing the same with ESTA. So I think the manipulation thing will diminish greatly, and you can be sure that the regulators will be monitoring that very, very carefully as well. So I think we will put this whole episode behind us about, you know, the market not trusting the reference rates as, you know, has been the case maybe in the last few years.
Thanks, David. Your thoughts on that?
Yeah, look, I would agree. I think just take SONIA as an example. It's administered by the Bank of England, and they are referencing actual transactions. And so far as administered by the New York Fed, they're referencing actual transactions that occur through the various clearing houses that they have in New York for repo. So I think that it becomes extraordinarily difficult. You can never say never, but it becomes extraordinarily difficult for those rates to be manipulated. The question, I suppose, that underpins the term structure, if a term structure evolves that becomes used in the pricing of non-derivative assets, right? That, I think, is probably what they're trying to work at the moment, to ensure that the transparency and the robustness of the calculation of that term structure also passes that litmus test. So let's see. But is it a massive improvement on what was there previously? Absolutely. Right? Is it going to be infallible? I guess there's always a kind of 0.0001 possibility of something happening.
Okay, so there is a question that was addressed to first Abu Dhabi Bank, and it is asking about the IRSs and how would the repricing take place for those interest rate swaps, if there are any thoughts on this?
Yeah, well, as I say, the interest rate swap market, the short-term reference rate, so you've got a 5-year fixed or whatever, and currently got 3-month LIBOR against it. When under this protocol, under ISDA, once they reset that to SONIA, they'll do that, and they're working a methodology about what the premium is that is added to the SONIA rate and so on. So I expect now that the ISDA protocol's there, that everyone will sign into it that's in that kind of market. And I said earlier, you know, First Abu Dhabi have done that already. So we'll just kind of, you know, take all of our sterling swaps and we will apply the ISDA protocol, and that will be our transition.
David, do you have any ideas you want to share about the IRSs?
No, I think Martyn has highlighted it. It's a fairly transparent and a fairly well described process of how you transition. Well, first of all, the fallback language, and the fallback language then describes how you transition. And I think that the vast majority of the market have already subscribed to ISDA protocol. Notably, it's probably important to say institutions such as the Bank of England have also signed up for the ISDA protocol. So I think that it'll be again, you can never say never, but I would assume the vast majority of counterparties would do exactly the same thing. And in certain circumstances where they don't or can't for specific reasons, there's a whole waterfall of what happens in those events as well. So I think it'll be, I wouldn't say seamless, but it's relatively well thought through and planned.
Okay, going back to the analogy that Martyn made earlier about the house, and then how you're doing the wiring and the plumbing. So how much is this, like, I'm not expecting a figure, but in terms of like the cost for the banks to implement this transition, whether be it investment into infrastructure, into system upgrades, into appointing consultants, into training staff, into having all this project team, putting all these man hours. What are your thoughts on that?
It's quite an expensive project, actually. You know, to give some idea of scale, because they're quite open. But when we were talking with Citibank, for example, and some of the guys at HSBC, I mean, they're talking, you know, $200–300 million of project spend over the life of the project, and having, I think Citibank said they had about 30 people working full time on this through their organisation, and lots of other people kind of working, you know, for that team. So it is a real commitment of resources. I can't even remember the exact numbers with FAB, but you know, I can tell you that we have got a project office. We've got about 3 or 4 people who are full time in that, liaising and organising all of our resources. And we've got a working group that's probably about 20 or 30 deep. So we have a working group of all of the major functions that, you know, typically with all of the banks. So we have reps from there that, you know, are working on this. And also we've had some support from consultants as well. So so it's a big commitment. And again, this comes back to, and you know, again, just to share that, because when we were first thinking about this, you know, the suggestion was, well, this is more of a treasury kind of a thing. So let's put the group treasurer in as the project manager, and he can liaise all of this and organise it. I said, look, believe you me, the last person you want organising this bank is me, or probably any treasurer of any bank, to be quite honest. We need in professional project managers that know how to map and, you know, do all those kind of Gantt charts or whatever it is, and to just have the time actually to pull together all the different threads, attend all the meetings. You know, we've got, again, our project team guys are joining to all of these kind of you know, seminars that ISDA do, London Money Markets Association, the Fed meetings. So any of those kind of public forums that are out there, you know, we're attending and making sure that we're receiving all of the information. And you can only really do that if you put the resources into it and have that level of coordination. But I'd really say that you need professional project managers to manage this for the entire entity, and, you know, then just kind of figure out, depending on the size of your balance sheet. And again, it will differ, because like for FAB, you know, 20–25% of our balance sheet is actually international. So we've got a very big footprint in that. Now there'll be other banks here in Abu Dhabi and the UAE that have got much more localized ones, and so, you know, their degree of exposure to foreign reference rates is quite small. So you need to size it yourself. But I think if you've got anything more than 10-15% of your balance sheet that references dollars, typically in this region, then then you need to get onto it and set up the infrastructure.
Thanks, Martyn. What about your views, David, on that?
I think it's similar. I think we've first of all, it's a smaller balance sheet, but we have a different business model to FAB. So we took a slightly different. In principle, we took quite a similar approach, but the nuances of it were different. The one thing that we wanted people to do was we wanted each business, each legal entity, each support function to own it. And the importance of that was that we felt they were the best people to actually be able to understand what the implications were for them. So somebody who works in risk, right, so long as they're given the time and space, is the best person to tell you what the implications of LIBOR transition are within risk. And similar principle applies to whether it's finance, whether it's IT, and so on and so forth. So the way we organized it, we had, if you think about it, as a series of horizontals, which was each line of business and support function, and then a series of verticals, which was each legal entity. And we developed a team of basically current employees, right, along those lines to take ownership of this in conjunction with some of their existing activities. And then we built a project support underpinning that, and we did have some help from an external consultant as well. So for us, that's how we've done it. And I think it's worked well for us because at the end of the day, we're a business. We need to understand what the implications are and any externalities on the business. We need to be able to think about them, and we need to be able to respond to them, right? And that was the important principle for us. But we would, if it was a Venn diagram with what Martyn's described, we'd be very much, in line.
Okay, so we have like 6 minutes before we end the session. And I will ask a final question, which is, if you would be kind of giving a suggestion or a recommendation on 2 levels, so for the financial institutions and how they need to prepare themselves, what kind of activities they can prioritize, if they haven't started, as Martyn said, that automatically, because it's LIBOR, then the group treasurer is going to be involved. So in terms of setting up the project teams that need to be working on it, so that is on the corporate level. And then the second level of advice or recommendation is for the individuals. If they want to learn more, if they want to get to know more about the transition and what they can do for their own personal development, so what kind of advice you would give them? So I'll start with you.
Take the first one on the setup, and David can do the educational piece. That's okay. Yeah, look, on the setup, and I think we've kind of said it over, but if you haven't established this yet, then establish it quickly. Once just make sure you do a kind of an overview about whether or not you've got balance sheet in these products and derivatives and so on. And I'm sure the treasurers and the people on the call will know that. But once you've kind of understood that this is something that is happening, if you haven't already established the group, you really need to go for it now. And in terms of establishing it and the membership, this is to me something that needs to go to the executive committee of the bank. So whoever your executive committee, like in my case, it's my CFO is my ExCo member. And when we put this together, we kind of said to him, look, this needs to be a group-wide project. It needs to be done in that context. And, we gave him obviously all the briefing papers and so on. But it needs to be established as a group-wide project with full buy-in from all of the people. Say budget needs to be allocated to it and, sufficient to meet those needs. But as I say, right now, this is becoming, quite, we established our projects, as I said earlier, in 2019. I think it took us 6 to 9 months to figure out what it was we needed to do before we started executing anything. So, you may be able to speed that up now in the light of things that have happened. But to me, it's really critical that 2 things: start now and do it on a group-wide basis and get the ExCo and the CEO to understand what you're doing and to make sure that all of the other ExCo members contribute to the project.
Thanks, Martyn. David?
So on Martyn's point, I agree with that fully. I think if you haven't started, and I'm sure most banks have started, but if you haven't, you need to get going, because it's coming, it's unequivocal, and at the end of the day, your customers need to know what they're migrating to. On the training, that's a very good question, and actually I was trying to think as to what the best answer to that is. There is a vast amount of information if you go onto the web and look at just even put in alternative reference rates or anything like that. And I wouldn't recommend doing that. And the reason I wouldn't recommend doing that is because there was so much debate, deliberation, alternative plans put forward, and so on and so forth, right, in terms of how this might evolve over the last number of years, because this has been going on for years. This isn't just start last year or the year before just because FAB or AUB decided to have a mitigation or a transition program. So for me, I think the easiest way to do it, if I was thinking about it from an education perspective, I'd want to know where were we, why are we moving, and what are we moving to? I think it is as simple as that. And if you go to either the Fed or if you go to the website of the Federal Reserve's website, or the Bank of England's is particularly good, or you can go to the ECB, right? All of them have sections on this, and you'll be able to, you know where we were, that was LIBOR. You kind of know why we're moving, right? Because the rate isn't reliable anymore for the reasons that we outlined, and you know where we're going to. So actually you just have to learn about the rate that we're going to, and that's pretty straightforward, because interest rates, I think a lot of the people who are watching this today will be very familiar with their construction calculation and their use. So I would try and keep it narrow, right? Because as I said, if you don't, you can get lost in the data.
Exactly. I mean, with the quantum of data that is out there, and this is, a universal problem, not only for the LIBOR transition, but generally with all the information that is out there. So if you have any closing remarks, and I'll start with you, David, just to sum it up, and any closing remarks you'd like to add.
The only thing I would say is that when this first emerged, I had to admit I wondered about the feasibility and the practicality and the actual rationale and motivation behind why we were moving for LIBOR, leaving aside the nefarious practices that occurred. Now that we're a long way down the road, there is no doubt that we're moving into a far more robust, a far more transparent, particularly if a term structure emerges, environment for the setting of benchmark reference rates. And that means that the financial community, the users of financial products that reference these rates, and generally kind of, I suppose, commerce and society are going to be in a better place. But it's been a long road to get from where it started to where it is. But then I think you probably should give cognizance to the fact that LIBOR itself, in first genesis, was, I think, in the very late 60s. Although the BBA started publishing it in the mid to late 80s, I think the first thought process around how LIBOR was constructed came about in the late 60s, early 70s. So maybe it had a good life.
Thank you, David. How about you, Martyn, your closing remarks?
Yeah, I'd just say, look, the closing remark is, don't be overwhelmed by this. It is a big change, but as we've said in this, that we're following standards that are being set in the relevant markets that we're operating in. So this is absolutely doable, but you do need to do it, and you do need to get organized, and you need to get starting on all of this, because even if you kind of know what the destination is and what you need to do it, there's a lot to actually get to that destination. So get geared up, get your ExCo behind it, and start moving forward.
Thank you very much, David, Martyn. Thank you a lot for today's session. It was truly insightful. I personally learned a lot from you, and it was pretty engaging. Most of the questions I was asking was actually from the audience. So, and I do see a couple of positive feedbacks there. So I really appreciate your time, and I look forward for future discussions. Thank you very much.
Okay, thank you. Thank you, everyone.
Bye.
Bye.